Well, thanks, Jack. It's great to be here, and it's great to be here with you all, the audience, that are interested in this discussion that Nick and I are absolutely passionate about, as is everyone at Adrenaline. We are a full service brand experience company, and we work with financial institutions like credit unions around the country, different sizes, different markets, all to help them grow through brand transformation and branch transformation. So, our topic today really touches on both of those key topics exactly. I am absolutely thrilled to be joined by Nick Mentel. He's our Managing Director of Insights and Analytics. Also happens to be one of the smartest people I know, with the steadiest approach and just a lot of real world experiences in looking at the data behind credit union growth from a branching strategy standpoint, and then aligning that with brand strategy so we connect the dots for performance. So before we go into the theory behind it and all of the data and analytics, and don't worry, we will do that quite a bit, we want to start by telling a story. Sometimes it's best to dive right into an example. And this is a story about a credit union that is aligning their branching strategy and a data-informed approach to new market growth with a brand strategy and a brand experience that separates them by looking ahead to a zero transaction future. And this isn't the future for every credit union. It's not the right future for every credit union. But for M-People Credit Union, which was facing its own unique challenges, like all of you are. And people had recently rebranded from Deere Employees Credit Union, as in John Deere, headquartered in Illinois. They're about $2.3 billion in assets. They never had branches there because all of their branch locations were actually within Deere environments on Deere campuses. So as they looked to the future and to grow and to continue to stay vital, there was a credit union in Maine, right size, right place. And so a merger took place. They were called Infinity Credit Union. So both Deere Employees and Infinity rebranded under the singular flag of M-People. Now, the branch network in Maine was inconsistent, like many of your branch networks are, different formats, different sizes, different styles. They were scaling across geographies, not only into the main market, but across different main markets and micro markets with different demographics to serve. And they were looking to the future of a low to no transaction approach. So that idea of advisory and relationship based, they really put their money where their mouth is in designing for the future. So the solution to meet these challenges was an investment strategy, branch by branch, that was data informed, and then a tiered kit of parts design. And we hope that kit of parts doesn't sound too nerdy, but it is a way that you create brand consistency for an experience across the branches, no matter what size they are or where they are. So let's start with the data-driven part of this equation. And Nick, tell us the story of M-People and how we began to solve their challenge.
Sure thing, Juliet. And if kit of parts was too nerdy for you, the next few slides are going to be a challenge. I'm sorry. We do have very much a right brain and left brain on this call between Juliet and myself. And let's start with the left brain. From an overarching strategic perspective, we like to work big to small. So understanding legacy infinity, what does that network look like? What are macro demographic, macroeconomic trends? As we all know, in the last 6 years, a lot has changed. Live work patterns have evolved. Consumer behavior has certainly changed a lot. So, really, not just what the world looks like today or 6 years ago, but what will it look like in 2030 and 2035 in terms of an evolving landscape and how an institution like in people needs to serve a market it really is not traditionally familiar with. And so, what that evolves into is a perspective on overarching trends into a network or institution specific review. And this certainly requires collaboration from our credit union partners and clients in these engagements to access a good bit of data, including where are your members today? Certainly, an important starting point relative to branch locations. Heck, for an institution with a footprint like in people that from the Deer side has a national legacy, where are members nationally, regionally, relative to branch assignment, and perhaps more importantly, expansion markets? Are they starting from a place of hundreds of households within a 3 mile radius of a prospective site? As that absolutely is a material factor in expansion considerations. Does that distribution vary by line of business or by product type? Certainly for credit unions, it's not uncommon for indirect members to have a good bit more geographic diversity than those branch booked accounts historically. And then, so, once we establish where we are, moving to where we're going is the next logical step, mapping out existing network and prospective new sites. As a data guy, I recognize the value of the quantifiable side of this, demographics, competitive density, macro trends in terms of unemployment rates and housing starts, et cetera. But I would have to acknowledge too that a magnifying glass needs to be applied to any sort of expansion study and a degree of elbow grease to consider local news, current events, residential and commercial development, et cetera. Not just what a census may be telling us, but really what's going on the ground in these markets. It's insufficient, frankly, to simply allow the quantitative data to rule the day. And that hurts me to say as a data guy, but it is absolutely true. And once that point has been established, carving up markets into distinct geographies, understanding what not only the demographic alignment to the institution may be, but also psychographically, we need to target members who will hear the message of the institution and it'll resonate with them. So building a plausible growth path from there, understanding the concept of the network effect, perceived brand and branch ubiquity and convenience, and we'll get to that concept in more detail in a bit. But market identification, that's a critical first step. Where is the institution considering going? Where have they been in the past? What is viable from a capital perspective? All of these needs certainly have to be supported by specific site analyses. And of course, once markets are identified, hiring the right team members, marketing in market, particularly in a market with low brand equity, et cetera, is extremely necessary. And then from there, beginning to stitch together a future state network, maximizing market coverage. You can see this a little more effectively on our next slide, Juliet, with minimal capital outlay. Of course, these are very expensive resources, the facilities and the people that work in them. So understanding how we can spend as little as possible and maximize that perceived coverage of a market, in as much as that is certainly a driving factor as potential members will consider joining the credit union. And this involves drive time and population coverage analyses, et cetera. There certainly is a science to it, but there's admittedly an art as well. And then ultimately, from a dollars and cents perspective, any of these investments need to generate a positive return. And of course, the world is unpredictable. There will be events at a macro level and certainly a micro level that can impact any forward-looking pro forma, but establishing what potential does a market bear in terms of deposits and loans by line of business, working backwards to effectively estimate how much can we capture given the market, given our brand equity or lack thereof, the format itself, how much we are spending on marketing, et cetera, how much growth is feasible in the next, not just 3 to 5 years, but beyond that. measuring spend against market opportunity. And this is all subject certainly to a whole host of assumptions, but working collaboratively with our clients to really make this as accurate as possible makes the entire enterprise more defensible, especially when it comes to board approval from a capital budgeting perspective.
Yeah, and I think to the point of there is both art and science. The science and the data behind where to invest and why and in what formats are ultimately not going to deliver return unless the design of the experience is something that will meet the needs of all the members and the prospects in these areas. So, and people did, I took a look at a, a kit of parts that was tiered across varying locations with varying conditions, as some of you might be familiar with from your own branch networks. And this is becomes, as their expansion through Maine, really a test and learn environment for what does the future of zero transaction or very little transaction look like. So that doesn't mean that you cannot transact, but it means that the spotlight is no longer on transaction, but is rather on conversation. It's on greeting and hosting. It's on opt-in seating locations that are all about relationship building versus transaction handling. And so this branch environment, or these branch environments, say something really powerful before a banker or a credit union or even opens their mouth. When a member or a prospect walks in, this design says, "You're welcome here. Please come in. This space is for you." It creates a sense of belonging, or at its core, really the idea of people who are there to help people and are there to guide those conversations forward. And we love to just also highlight, because nothing is without its warts, I guess, or its hiccups throughout the process. And people had a lot of really interesting and beautiful existing spaces to transform and to renovate, or in some cases just to refresh. This one is an interesting one worth calling out, because if any of you have ever been to an escape room, you know what I'm talking about, which are these big meandering, really designed fit for a very specific purpose, and people then needed to create a branch experience that would deliver on everything that it needed to: advisory, relationship driven, low transactions. And so this is a 2-story escape room that has been seamlessly transformed for MPeople's members, prospects, and its employees to support the future of both this brand and its experience, but also the future of the credit union itself. So we are continuing to look at the future with MPeople and learn what can be learned from these environments as they grow forward. So we just saw some branches that are absolutely designed for the future. But let's go back to the conversation where the industry was with this really cheery headline, that just 7 years ago, I can't believe 2019 was only 7 years ago, but 7 years ago, the drumbeat of the branch is dead, and digital was going to not only disrupt the industry, but really make obsolete the need for physical locations. And the drumbeat continued. It wasn't just the one headline. Then we had COVID, and COVID happened, and everyone was driven truly digitally. There was very little opportunity for in-person branch experiences. And so that message grew louder and louder across the media, and the industry responded with net closures outperforming net openings. And this seemed to be the future that we were looking at. So just 7 years later, as was illustrated with M People, that narrative that the branch is dead. We're happy to report Financial Brand and Bankography published a piece just this year. And we know that by looking at a macro view of the industry itself and the very real behaviors that consumers continue to show. And just in the last couple years, consumers use branches more than any other channel. And they did that. They're getting advice. They're going for problem resolution. They're going to open new accounts or acquire new products. And so this channel continues to be the most vital channel for relationship growth and ultimately acquisition growth as well. And so when we dive into the data itself, what we see is a reversing trend of closures to net openings that has not only leveled out really from its high in 2021, but even we're at lower closures than we were for the decades before that. And so just in the past year, there have been 500 net openings of branches. And excuse this hyper close-up of Jamie Dimon's face. I don't know that anyone needs to look at him so close up, but there is something, though we like to consider ourselves, all people do, as utterly rational creatures, that of course, if it's easier to do something, we'll take the easiest path. There is an enduring psychological need that human beings have, one, to connect with each other, but two, that idea that Jamie Dimon identifies, that you like to visit your money. You want to see a physical place that is staffed with people who can talk to you about your money. So we're seeing the nature of branches change, but people are still going there. And of course, Chase is really the at the absolute vanguard of branch investment, went out way before others were with massive branch expansion and investment. And it is because digital has disrupted. I don't need to tell the audience here, there has been a mass disruption, but it is where transactions that are easy to do, that are people feel comfortable and safe checking bank balances, making transfers to their account, doing a little bit of research. It's where you do banking, but branches are where you win and deepen those relationships that ultimately deliver loyalty with members. And we know that branches are essential, again, data-ing your face off with some of these really powerful statistics that we have seen, is that to even get into the consideration set of a potential member, access to a local branch is absolutely crucial before they'll consider it. And in fact, they want to be within 15 minutes of you, which is where Nick's going to talk about perceived presence. It really comes into play there. Almost 90% of all consumers have actually gone into the branch in the past year. And it's really important for retention. As we look at those accounts and products that become deeply sticky, those that happen, that originate in the branch, deliver, whereas those that are digital are easier to move away from because there's nothing else connecting you to that brand. And hot off the press from Accenture this year, I think this idea that, and we're using the term customers here to speak about customers generally, as in customers' experience, branches are favored for complex needs. And it's such an easy visual that you see that it goes from very light purple to very dark purple. So when it comes to opening new accounts, to getting advice, to applying for a loan or a mortgage, or even having that discussion, that's where people prefer in branch versus digital channels. And actually the darkest purple little dot there is about receiving financial advice. We also know that if members receive financial advice, 75% of them will act on that. So that need for advisory and for growth and winning and deepening those relationships are absolutely true, because branches represent this sense of safety and what credit unions deliver in spades by who you are and your purpose-driven model, that idea of trust. We also know that this is not just true for older generations who grew up where the branch it became muscle memory. Really, there's very little statistical difference between groups of consumers who want to see branches in their neighborhood, because it says this financial institution is available to me when I need and is stable. And in fact, 65% of Gen Z want to look at someone in the eye across the table, sitting next to them, to open a new account in person, and having that sense of a quarter of them, they want to have a discussion around the big milestones in their life. TikTok's there. They can get advice on TikTok. They don't trust it as much as they do having a discussion with a financial expert. And even those people who are younger generation, who are Gen X, who are boomers, even if they prefer online, even if they might only go into the branch a couple times a year, they want the security and reassurance of the nearby branch. And that's true even if they never use it. Remember that idea that just to get into the consideration set, you have to have a branch that signals where you are. But that purpose is switching. And Nick, I love to hear the way you voice over this idea of what we look at branches for and how their nature has changed.
Yeah, if we believe the branch is important, which it is, empirically, that's been backed up. Anecdotally, your members are telling you that, then what purpose does it serve today? And I'm probably not telling anyone in this call anything they don't know intuitively, but it can be enriching to discuss it on a very functional level. So let's talk about the purpose of the branch itself, which really has been inverted from what it used to be historically. It has evolved and continues to move from transactional to a new purpose as a place to connect, learn, share, gain advice. You see that front door, really, the branch can serve as a very effective marketing tool, which was not the case historically. The facilities themselves were somewhat drab and not eye-catching. And it's certainly much more of a marketing function today. Beyond that, as Juliet described, certainly a psychological safety net for members during important moments in their life and seeking that guidance. Obviously, always having a human touch there in a digital world, it's certainly critical to have that option from a trust perspective. And then, sure, you need to serve your members' basic needs and functions in terms of cashing checks, in terms of essentially basic operational functions. And so if the branch has evolved from the perspective of the member, what does it mean to you as an institution, and how do you invest accordingly? So we believe credit unions should realign their thinking in terms of branch utilization toward how those members are using it. Ultimately, it's a zero-sum game. You have capital to allocate toward your network. And for all financial branches everywhere, we believe business purposes really rolls into the four drivers of value you see on screen here. Acquisition, essentially member growth, reinforcing the idea if you're not growing, you're dying. Cross-sell, share of wallet. Loyalty, implying member tenure, and one that does correlate very strongly to cross-sell, the greater share of wallet. Typically, for every product you have with a member, there's an additional couple of years in average tenure that you'll have as a member of the institution. So critically important. And then finally, efficiency, serving member needs while minimizing operational expenses. And we also recognize that varies a lot by market and even by branch within the same market. And just using two extreme examples, a very aggressive growth market versus a legacy market where the ceiling may be somewhat limited because you're a victim of your own success to an extent. You've done so well over the decades in aggregating household share that acquisition and cross-sell certainly are critically important in those net newer markets, whereas identifying areas of efficiency, is it occupancy? Is it personnel? Heck, is it hours served in a given week? In those legacy markets are more of a priority. There's less volatility around loyalty, which is consistently vital. But we want to help you save to grow. And we've done some research around this as well. Juliet has shown plenty of third-party research, but Adrenaline has the benefit of working with our clients and understanding how transformation has affected their ability to grow deposits, to grow members, et cetera. And the results are extremely positive. And these are long-term results as well. Conducted a study in the last couple of years demonstrating that post-transformation, institutions on average are seeing deposit growth in excess of 22% of those networks that have not been transformed. And certainly there's a scale of transformation, and all of this requires capital to an extent. But in terms of pure deposit growth, and that growth has been indexed to the MSAs of the clients in this study, as well as member growth, showing that two-thirds of these institutions outperformed industry averages, is an extremely compelling case. And we understand that it's risky and it's scary, frankly, to sink capital into the network that may feel like a relic at times, but the results are incontrovertible. Juliet touched on this idea earlier as well. The idea of perceived presence, perceived brand and branch convenience. The network effect, and I'm sure many of you are familiar with it, the idea being when an institution achieves a certain threshold of physical branch share in a geography, and that geography can be as wide as a state or as small as a corridor within a county. Generally, we do see an increasing deposit share, really the steep part of that S curve there, the black line, where there is greater deposit share than branch share in a market because members, or more importantly, prospective members, are thinking, you know what? There is a branch right around the corner. And even if subconsciously it affects their willingness to become a member. And at a macro level, it's an area that credit unions have struggled with to an extent. Really, every institution type, aside from large nationals, has. Awareness is not distinctly different from regional banks, community banks, fintechs. Neither is consideration, but that conversion to purchase has been a real struggle for credit unions in particular. And like I said, every FI aside from national players, because national players have the benefit, going back to Jamie Dimon, of unlimited capital and the ability to put branches everywhere to really force that perceived convenience in the minds of members. What we are seeing evolving over time is certainly the capital requirements for a location and how that manifests in terms of format design. At the turn of the century, the average branch new build was between 5,000 square feet, and that has been halved essentially to closer to 2 to 3,000. And it certainly varies by market and by the intent of the institution and the lines of business they hope to serve. But by leveraging a hub and spoke approach, minimizing basic functions in those smaller spoke branches can lead to more capital efficiency while still maintaining a high degree of that perceived market coverage. A tangible example of that, and we'll dive more into this client in just a moment, is Credit Union of Texas, a longstanding Adrenaline client. And this just briefly shows an array of formats intended to meet the market opportunity and the complexity of services offered in various formats. The synthesis of these overarching ideas that we've talked about in the last 10 or 15 minutes, fundamental market analysis, value driver alignment, perceived convenience, allows a network strategy to start to take shape and really provide prescriptive prioritization of actions within existing, because you need to start from somewhere, but perhaps more importantly, net new markets, applying your value drivers to those branches. And really, it allows for a roadmap to essentially kind of build itself. Beyond that, just a couple of functional points, not to bore you to tears with data. At a micro level, there is a tool we leverage from our partner Kiranos called billboard value. I think identifying market opportunity is easy enough given household growth rates, income levels, competitive density, et cetera. But understanding how appealing a site is in terms of drive-by traffic, mobility data, frequent retail destinations, civic locations, other financial institutions can at least directionally begin to point us toward, okay, this submarket is hot. What census block group may be a good place to begin a site search? So it's certainly not the end all be all answer, but an important step along the process. And bigger picture, as we assess an existing network and expansion markets, and again, this is credit to Curinos for much of the data underpinning this model. We leverage a four-factor model to assess actions by network, and that involves potential, and that's just what it sounds like. Where is their growth? Where is their money, et cetera? Competitiveness, what sorts of institutions are in an area? How densely branched is an area in terms of deposit growth and so on. Position, where is your placement on that network effect curve today? How close are you to gaining critical mass? And is that next dollar spent best spent in terms of reaching that threshold, or would it be a net new market? And then finally, performance, whether it's deposit growth, profitability by branch, whatever metrics are important to you as an institution needs to be folded into an evaluation of the network at large in order to synthesize this go forward roadmap.
So going on the whole left brain, right brain, I actually forget which one is which and which I'm supposed to represent, but
You are right brain, the
oh,
creative
okay.
brain.
Thank you. Thank you. I know how to attack this then. The data is, as Nick mentions, tells you exactly where to invest. And that's what analytics are for. We want to make sure that we're not just sort of throwing a dart out into the wind or going to where we think there is opportunity, but where it's absolutely defensible that there is, that we know there is. But brand is going to ultimately determine whether the investment in branch delivers everything that you need it to for performance and growth for credit unions. And so these are not either or, they absolutely are both and considerations, and they work best when delivered together. So we're going to share some examples of those credit unions who have leveraged both brand strategy and branching strategy to optimize their growth. But first, I want to just ground us in what we're seeing from a brand perspective. And this is all from third-party research, that especially for credit unions, especially for all financial institutions, but for credit unions particularly, the need to have a differentiated brand for a prospect or a member or a prospective recruit to be able to tell who you are as distinct from the credit union down the street or the community bank in one town over. It is the number one factor in determining, or branded factor, determining your organization's performance. And in fact, every 1% increase in the ability to just tell the difference between each brand drives a 2.5 increase, in this case, shareholder, or ultimately your shareholders are your members. So brand is not a nice to have when all the stars align. It is actually a growth driving lever that should be put to advantage. And we know this not only looking at financial institution brands, but looking at all brands over the past 20 plus years. The strongest brands, those that are most distinct from their peers across all industries, outperform by massive amounts, 132% outperform their peers. And we're looking at the Morgan Stanley Consumer Index here. But they also help to drive, to put it in a crass way, to drive sales volume 3 times. So the stronger the brand, the more distinct it is. And the more distinct the brand experience is as represented in the branch experience, the stronger the brand will perform and the more it can not only win, but deepen relationships and be a powerful tool for cross-sell. And this is important to know because competition's fierce and it's only getting fiercer every day, even though we are seeing consolidation across the industry. So there are fewer players than they were 5 years ago, 10 years ago. There are still nearly 5,000 credit unions in the US, and that's not to talk about the nearly 5,000 banks in the US. So even if your prospect only needs to choose between a very small percentage of this 4,700 in their market or that they are available or eligible to join, that is still a dizzying amount. So you are being judged by both brand, branch presence, and brand experience. And it's important to keep our eye on the member expectations and how they've shifted over time. There are many things that remain the fundamentals of credit union brand experience that that members are looking for, but there are some brands that are stepping out, differentiating and winning because they're helping to meet the member expectations. And so just a few of these that we've learned through research, and I'll share where you can access the research in more detail, that members want credit unions that are bold. And what we mean by that is that you can't drive past them and not notice them, that they stand for something, that they're proud of being a credit union, that they are embracing the energy of the moment and the energy of their members, just like Beginnings Credit Union in upstate New York that recently rebranded from CFCU, Cornell Federal Credit Union, which had then been Community Federal Credit Union, but really capturing an utterly differentiated position in the market as expressed across all of the touch points from marketing and ultimately branch experience. This is not new that they want credit union brands that feel local, but what we have seen in the data around member expectations is that post-COVID, the idea of being local, feeling local, has a bigger premium than ever. That idea that you are of and about a place, you celebrate that place, and that place is distinctly your place, and it creates brand and branch experiences that bring that to life. Just like East Rise Credit Union in Vermont creates a place that celebrates the textures and the feeling and the visual vernacular, and even puts the care for their communities right up front and center in their branches. And so this idea of feeling local is no longer just a community wall in the side, but it really becomes a guiding factor. They also want credit union brands that embody optimism, people helping people, that sense of purpose that underlies the credit union promise. There is a sense of real energy and a sense that this is a place where we can find both financial advice, but we can also find community and that sense of belonging that people are seeking, and that they are ultimately, there are parts of the branch experience that are shifting to help fulfill that need. And they also want credit union brands that feel real, like, let me give a shout out to BrightBridge Credit Union that had recently rebranded from 3 legacy credit union brands, came together as BrightBridge Credit Union in the Boston area, that really captures that sense of optimism and looking ahead. And Mirastar Federal Credit Union recently rebranded from Santa Clara County Federal Credit Union, sorry, I always miss one of those words, captures a brand that is by, for, and about its members and celebrates the the real people that they serve in their markets, and even in their branches celebrates them enough by listing them by first name in the entry wall. Everyone there is welcome, and the brand reflects that across all of its touch points. The way we know all of this is because of some of the reports that we have recently published. One is Winning Gen Z, which we look at younger generations and the experience drivers that they seek out of their financial institutions. And another is Closing Customer Experience Gaps in Branch Banking, which was the result of a very rigorous mystery shop study across the country and across sizes of institutions, in which we really were able to reveal some gaps. And the member experience gaps that came out of the mystery shops, and this is specific to branch banking experiences, is that 80% of all businesses, if you ask them, they're like, yeah, we're delivering really great, superior, in fact, member experiences. But only 8% of consumers or your members will actually agree with that. So there's room to grow. And there are 4 big ways that our mystery shoppers, the big trends that emerge. One is maybe the lowest hanging fruit is experiences that begin without someone looking up and welcoming you to the branch, or at least acknowledging your presence. The idea that the conversations are feeling more salesy, less about you, the member, more and your experience and your needs, and more about what we're trying to sell you that day, which didn't inspire people to return, not surprisingly. And we're also seeing that staff isn't leveraging the digital tools that are available to them. Now, some of these are absolutely addressable by design, and that's what we're interested in sharing. But first, there is an experience gap when we look at next generation, and of course, all generations, as we look at both branch presence and your branch position, are important to address. But particularly when we look at next generation, which is where growth will come from for credit unions of all sizes, we know 80% of younger generations already hold their PFI with a financial institutions, but only 31% are with a credit union. There is massive opportunity there, because we also know 30% of them are actually planning to switch because they are dissatisfied with their current banking experience. And so the delivery of a brand and branch experience that meets younger generations and all generations with a purpose-driven model and a purpose-driven approach and design where the investment matches the opportunity is really the gap that is looking to be filled. And speaking of gap, I just mentioned these 2 key ideas. The position of a brand, which is really a great way to think about brand experiences that help grow relationships. Your position is who you are. Your presence is where you are. It is where and how you locate for acquisition and efficiency. And there is a gap between those. They are looked at in silos. So Nick's left side of the brain focuses on that idea of presence, which will often happen as institutions look to fulfill a branching strategy without considering the position. So another way of saying this is, if you can have the most beautifully designed branch in the world, but if it's in a dead market, who's going to go? So what we want to do is close the gap by your position and your presence. So it's who you are and where you are, and considering those in conjunction, ultimately leading to performance. And a couple examples that we want to leave you with in our last few minutes here around some credit unions that have done exactly that. So we're going to go quickly through these last ones. That the challenge here is leveraging brand and branch. So it is position and presence ultimately for new market growth. And Credit Union of Texas They are thriving, about $2.6 billion right outside of Dallas. Had a very established brand and ownable recognition, and they were ready to make some moves into new markets. Now, these markets were very competitive, very expensive, but the growth was absolutely critical. Everything's bigger in Texas, as we know, and it is one of the fastest growing areas of the country. And there is so much competition there, not only from banks, but from other credit unions as well. There was massive capital needs that were significant there. So a data-informed, smart branching strategy with different branch archetypes. So when we think about that hub and spoke formats that Nick spoke to, this is what that looks like in practice. And Nick, talk us through, left brain us again.
Oh, you used the phrase investment meeting opportunity a few minutes ago, and that's essentially what the goal of this
Thank you.
exercise was, creating impact and perceived scale, but needing more self-service automation, smaller formats. We don't need to relitigate how the sausage is made here necessarily, aside to say that, there is obviously value and due diligence around assessing the health of growth areas, where are existing members, what sort of cannibalization could occur as growth occurs as well, or attrition as a network scales. Evaluating de novo product demand potential in concert with review of the qualitative aspects of a market, as I described earlier, and CUTX's line of business specific goals ultimately informed appropriate format selection. And to reiterate a phrase I used earlier, as much as necessary and as little as possible, which I'm sure the CFO always appreciates. Ultimately, to roll out a multi-year prioritized rollout of formats that will facilitate site search and selection. If we know what we're looking for, it'll be that much easier to find and or design. And speaking of design, that's really where this example shines, frankly, and you saw some of these images earlier, but really where data meets market opportunity warrants commensurate investment. And we'll step through a few of these sites working big to small. Think about those value drivers in the context as we look at these. You just saw the exterior, now you're looking at the interior of a flagship hub branch, high pass-by traffic, very favorable demographics, designed to amplify the brand and the characteristics therein, logo colors, et cetera. And the inside, the experience was to build and serve relationships with new members and cross-sell existing. The secondary opportunity market provided a better fit for something like this storefront inline. Certainly half the cost or maybe even less than the standalone. It's a visible end cap, drive up ATM, video teller access, and the brand impact is really maximized. The colorful branding certainly helps, but is the right real estate site selection helps as well. Also creating a warm, not only interior aesthetically, but also functionally. We've seen certainly trends toward more of a community-based space in that you are serving community. Credit unions better than any other FI in doing so. And so having a coffee bar paired with the functional aspects of the teller lines and advisory center was a home run all the way around. And ultimately, down to the lightest capital and OpEx investment, these remote ITMs you see here, certainly a polarizing asset at times in the industry, but it's undeniable that the cost is significantly less, about a fifth less of the capital and operating costs of a typical branch. And from a branding perspective, still extremely effective if well placed and can be very functional for a retail-based audience. You can see that in practice here, how the brand serves as a beacon in the community, essentially paired with a dog park in the parking lot to make it, again, more of a community space than a functional credit union branch, frankly. And so allowing, Juliet talked about kit of parts earlier, designing a kit of parts that allows for rollout across an array of formats allows that format design to meet opportunity and to really not overextend CUTX or any of our clients from a capital perspective.
Yeah, I'd love to shine a light on this next credit union, which was all about that idea of differentiation through not only brand, but the branch experience itself. We want to talk about Star One Credit Union. They are a credit union that is just under 10 billion. They are not, they're in Silicon Valley, Sunnyvale, California, which they were undergoing a couple different things at the same time. One is rebranding to better meet the needs of the demographics, very high net worth individuals there, highly educated population, lots of opportunity to grow with them. They were also looking at renovating existing branch networks, designing and building new branches, and ultimately rebranding. And so the solution became fulfilling all of that need for a new experience that matched the needs for what Star One was and who they were about, their position married to their presence. And so this is a credit union lobby that doesn't probably look like or does probably look like many other credit union lobbies, really doesn't stand out much. So this was before, post renovation. This is what welcomed potential new members with a highly distinct. You see that there are intentional moments of color and brand. We have furniture that is subtle, and architectural touches that are designed to elevate the entire experience. We have, as you go deeper into the branch, we have these little hidden moments where the brand can shine, these unexpected colors that leap off the page. There's it says, when it comes to personal service, settle for more. This little, it's like a wink of the brand at you. And as you go further and further in the branch, as we look into these areas for consultation, they are both branded, but they are actually highly functional, meant for personal conversation that could be sensitive. And finally, looking from the exterior, so a branded branch environment that you could drive by 100 times and never really notice it. And the biggest thing that Star One has to tell you on their signage is that they have an ATM. But as we transformed this brand to meet the needs of new members, the signage, the experience becomes lifted into a new level of visibility, that billboarding effect that Nick talked about. And the signage doesn't have to scream ATM, because the ATMs are utterly visible on the exterior of the building. They haven't shifted position. They are just, through design, become more visible. Another great example of this, which is honestly the most integrated example we've seen of both brand and branch transformation that pull together both position and presence, is TCU, that ultimately rebranded to become Everwise. They're about $5.6 billion now. They were located in South Bend, Indiana. They had been a teachers credit union. They tried to get away from only being, once their charter changed, to shift to TCU so they could signal that not only educators could join, ultimately rebranded to Everwise. And they needed to both understand how to build brand awareness and distinction for this new brand, but also do it as they are moving into net new markets. And in this case, for Everwise, Indianapolis. So this was really a yin and yang challenge that we took on together with them. And the solution became fully integrated, both brand and branching strategy that sought to raise their profile in their existing markets where they already had enviable market share, but also to help that grow into their new markets. So this begins with brand strategy. And just like Nick shows the sausage making of branching strategy, some of the internal building blocks of brand, which is all about powering people. That's not their headline, but that is their big position that they hold in the minds of people. And if they are about powering people, then their brand needs to embody that with vibrance and with member generated photography that helps to tell their story and keep them authentic and reflect the needs of their members, and an absolutely expressive, exuberant brand that speaks about the possibilities and what happens when people are given the ability to grow into their dreams. And this was brought to life speaking to members around that change, going into both existing and new markets with change messaging and communications, ultimately touching all of their digital assets, including, of course, their website, their app, etc. They're engaging their employees through culture training, through communications, through events that help everyone there be able to understand what it means to be part of Everwise, and even how they show up in the branches. And I'd love, Nick, for you to, I got the fun part of showing all the beautiful imagery, but I'd love for you to talk a little bit about how we then also help them think through what Indianapolis expansion would look like.
Yeah, maybe some of us think the numbers are the fun part, Juliet. With that new brand
Touché.
in hand, growth was certainly more possible than ever. It essentially unlocked the brand to a consideration set that would not have considered them as an institution, a viable institution in the future. So through, you can see forensic analysis, branch performance from a volume perspective, how many households per branch, how many accounts, from a rate metric perspective, cross-sell rate, checking penetration, single account households, and evaluate existing branch performance in the context of the network, in the context of industry benchmarks, et cetera, to begin to come up with very directional action recommendations and prioritized accordingly so that we could look at, okay, not as just where the existing network resides today, but as we grow toward this new market, and a complex large market. Indianapolis is the 25th largest media market in the US. Understanding all of those dynamic pieces, what needs to change with the existing network, how does that integrate into our prioritization roadmap for net new sites? And from there began to grow. Sorry, we've got all sorts of fun animation, Juliet. Beginning to do so again, not just in a comprehensive way that stitched together an ideal state network, but also through a hub and spoke approach that minimized non-interest expenses and allocated more complex resources as needed to those hub locations. All right, I'm rushing because I know we're up against it here.
We're up against it, but I would love to close us out with what it looked like. So we mentioned that it's both position and presence. So once we unlock the presence of where to go, we have to design accordingly the branch experiences and locations, both from an exterior and interior standpoint, that will ultimately pay off that investment. And that, by the way, includes Drive Up, which is no longer a forgotten area of branch design, but really can help to maximize that billboard effect. And these interior spaces, which help to elevate both the brand, create a bespoke brand experience so it is utterly distinct. And then even through their headquarters in South Bend, that becomes a celebration of the brand, both on the exterior and on the interior, and shines a light on their values as well. So to close this out with, oh my gosh, we're right on time here, and I hope we can stay on for a few minutes for questions. The closing the gap between the position, which is who you are, your presence, which is where you are and where you go, ultimately leads to performance for your credit union, brand and branch. And we are so grateful and honored to share this thinking with you and this work with you, and are happy to take questions. And as Jack mentioned, this webinar, these slides will be available to you as well. And of course, those white papers are available, those and more, for the research that backs up a lot of what we've shared today.
All right, Dale, thank you for moving us into the Q&A portion. And I know it is late here, so we'll try to get a few in, whatever we can. Um, let's see, I have one here. Of the top ways you presented, what do you think is the one biggest opportunity for credit unions to strengthen member relationships?
Juliet, you want to take that one?
Yeah, I'll take that one. The number one opportunity is to focus on member experience. And I know that's like a giant term, and it could mean everything from product to onboarding. But what I think about member experience is looking at your current membership and really understanding where you shine and where you have room to grow. And so that could mean looking at your current NPS scores. That could mean doing some research, potentially even some focus groups around your current membership and focusing on those areas to improve. And sometimes that's going to be around your internal culture, staff, training, and raising the bar there. And very often it is linked to design of experiences that happen inside of the branch, making things meet their needs. That touches digital touch points, and it also very much aligns with how you communicate with members too. When we look at member experiences across the board for credit unions, all of you hit very high marks of friendliness, being very friendly. Some of you hit lower marks in terms of people knowing everything that you have to offer. So being utterly clear about who you are, what you offer, and what you are there for. So that's the sort of biggest lever I see is around that focus on member experience.
Great answer. Next one here, and this is a great question because you actually talked about Gen Z and them picking their primary financial institution. And what do you think is the driving factor for Gen Z when choosing their PFI today?
Oh, I'm so glad you asked that question, because the data that we shared with the QR code actually answers this in detail. I'm going to blow your mind a little bit because you might think, because it blew our minds, and it is that you might think that it is an absolutely top-notch, seamless digital experience. That is table stakes. That will not move the needle one way or other with younger generations. The number one thing is to have to stand for something and to have a purpose that is clear and that you deliver on. The great news is that credit, by default, by the nature of the model of what a credit union is, you all deliver on it. There are some credit unions that are winning with Gen Z by delivering on that message of your purpose in real ways, both in product mix, but really importantly, in how you show up in communities and how you communicate. So putting your purpose front and center, delivering authentic experiences. Oh, and another big one is transparency and honesty. I think it's the third most driving factor in consideration among younger audiences for credit unions or for PFIs, period, is doing what you say you're going to do. I'll share very quickly. We did a Gen Z panel recently of real live Gen Z consumers at a conference, and what they said without any prompting really from us is that that PFIs or banks or credit unions try really hard to get them. And then once they have them, they feel like it's sort of they've hit a brick wall. So that idea that you do what you say you're going to do, you're transparent about your business practices, you let them know upfront around any kind of fees, all of those, and then ultimately that you have a purpose, that you have a meaning, that you're delivering something outside of just banking transactions is ultimately a big deciding factor for them.
Oh, I love that. Thank you for the enthusiastic answers. They're great. We have time for probably one or two more. And this is another great question. So let's say a credit union is not going to rebrand. Perhaps they like their brand where it's at, or maybe it's just not in the cards for a little bit. But how can they still create some more consistency between their brand promise and the actual member experience?
That's a great question. And I think that there is, Nick, do you mind if I take this? I feel like I'm
It's right in your wheelhouse, Julia.
taking
Go
up all
for
the
it.
oxygen in the room, um, in my room. Anyway, that where I would start is the idea of, and this is something that we talk with credit unions about a lot that are not ready to rebrand. They don't maybe need to rebrand, but potentially they have great equity right where they are. The idea that they look at in a very rigorous way their values and how their values become actionable for behaviors for everyone in the credit union, and do really invest time in training and understanding and bringing to life what does it mean if, say, we just like with Everwise that we looked at, drive is one of their values. It means they're gonna sort of go the extra mile. What does that look like if you are frontline staff? What does it look like if you are back of house? What does that look like if you are leading community engagement? How does that come to life? What are the behaviors that will show up that ultimately will deliver more distinguishable member experiences? I do give a great example of this is actually way outside of financial, and it's Chick-fil-A. And if you're not in the South or where Chick-fil-A is located, they are a fast food chicken restaurant, and they deliver incredible customer experience. And their branded environments are nice, but their brand really hasn't changed in 90 years or 70 years or however long they've been there. But they do have a service experience that is utterly distinct, that links back to their values. Their values are all about second mile service. I'm going to walk 2 miles in my customer's shoes, not just 1 mile. And the way that that shows up is if you say thank you to them, instead of saying you're welcome, they say my pleasure. And this is everyone from the high school kids that are working the register to the manager that will come out and actually open the door if he sees that your hands are full. So creating memorable moments that the staff help deliver is absolutely a great way to start. But the foundation, those values, how they're articulated, how they're shared internally, it starts there and then is able to become behaviors that affect staff, and then ultimately experiences that are designed in a consistent way to deliver that.
As soon as you mentioned Chick-fil-A, I started getting hungry, but that was an
Yeah,
excellent
sorry,
example.
sorry about that.
It's about that time. It's about that time. So it's 3:10. So just to be mindful of time, it's probably best if we start wrapping up now. I want to say a big thank you to Julia and Nick for sharing your expertise with us today. It was extremely insightful, and I mean, I actually enjoyed watching it myself as the co-host. So we really appreciate that. And of course, a big thank you to everyone who joined us live for the webinar. We hope you found the information today helpful on your own journey. Please keep an eye out for the post-event email. It'll either be sending today or tomorrow, within around 24 hours. And that wraps us up. Thank you, everyone, and have a great day.
Thank
Thank
you
you
all very
so
much.
much.